It is 2 in the morning inside a freezing conference room. You're staring at a spreadsheet that balances perfectly, but your gut tells you it is a complete lie. $100 million in fictitious revenue is hiding in plain sight. If you sign off, you risk going to federal prison. If you report it, your firm loses its biggest client. You are sweating through your expensive suit. This is the brutal reality of a Big Four auditor. The market entirely trusts your signature, but the market does not see the sheer panic inside this empty room. You realize that public trust is just an illusion maintained by exhausted graduates running on cold coffee and fear. Before we uncover the dark truth behind these financial statements, please subscribe today. Level 1, the first year audit staff in. You're 22 years old, you graduated with a Master of Accounting degree and passed the CPA exam before your start date in September. Your base salary is $75,000. Your title sounds prestigious to your family, but inside the firm, you are the absolute bottom of a pyramid designed to grind human capital into billable hours. Your first assignment is a cash audit for a mid-sized manufacturing client. The senior auditor hands you a spreadsheet with 10,000 rows of bank transactions and tells you to tie it out to the general ledger. You ask how to do it. The senior tells you to look at last year. This becomes your entire professional existence. Same as last year, SALY. It is not just an acronym, it is a survival mechanism for the chronically overworked. For the first 6 months, you do not analyze business models, you do not uncover sophisticated fraud, and you certainly do not speak to the chief financial officer. You speak to the accounts payable clerk, practically begging for blurry copies of invoices from 9 months ago. You spend 14 hours a day matching numbers on a screen to numbers on a scanned piece of paper, vouching, ticking, tying, documenting every single step so that the external regulators cannot find a flaw in the methodology. You learn that your primary job is not to find the absolute truth of the market, but to make sure your work paper looks exactly like the prior year work paper. So the manager does not leave review notes. A review note is a digital manifestation of failure. You learn to dread the specific ping of the audit software notifying you of a new note in your queue. By December, the prestige of the brand name on your corporate laptop fades into a chronic, dull lack of sleep. You realize the firm does not actually sell high-level financial expertise for your tasks. The firm sells your youth and stamina at $300 an hour. You sit in a windowless room at the client site, usually a converted storage closet, because the client does not want auditors taking up their prime real estate. You learn that the physical environment is a direct metaphor for how the client views your presence, a necessary annoyance mandated by banking covenants. You eat dinner at your desk every night. It is always a corporate expensed meal, usually a cold deli sandwich or a lukewarm pizza, eaten in silence while staring at a blinding dual monitor setup. You quickly learn the unspoken concept of ghosting hours, eating time to make the audit look profitable on the internal metrics. You work 14 hours, but you only bill 10 because the budget for the cash section is already completely blown. You do not want to be the reason the engagement margin drops. You're physically exhausted, running entirely on caffeine and anxiety, but you tell yourself this is just the necessary dues you have to pay. Level 2, the second year associate. You survive the first year, which in this industry is the only credential that actually matters. Your base salary bumps to $85,000. All in with your bonus, you hit $92,000. You are no longer the most junior person in the room, which means you now have to explain to a terrified 22-year-old why their cash tie-out does not work. It is January, the beginning of the busy season. The sun rises while you are under the fluorescent lights of the office and sets while you are still there. You have not seen your apartment in daylight for 3 weeks. Your life is measured in 15-minute increments and billable codes. Then comes the inventory count. It is New Year's Eve. And while your friends are posting photos of champagne and parties, you are standing in a freezing warehouse in the middle of a snowstorm in rural Ohio. You're counting rolls of industrial steel or pallets of frozen poultry. You are there to prove that what is on the balance sheet actually exists in the physical world. The client's warehouse manager looks at you with a mix of pity and annoyance as you climb a ladder with a clipboard to verify a serial number. Your hands are so numb, you can barely hold the pen. You realize that the high finance world you dreamed of is actually just manual labor with better titles. You return to the office at 3 in the morning to document the count, only to find 40 new emails from your manager. The pressure is mounting. The materiality threshold for your sections has dropped, meaning you have to test more samples with less time. You start to see the cracks in the firm's methodology. You see seniors taking shortcuts because there simply is not enough time in a 24-hour day to do the work properly. You learn the art of professional skepticism, which is really just a polite way of saying you believe everyone is lying until they provide a stamped and signed document. You are exhausted, but the adrenaline of the deadline keeps you moving. You are becoming a machine that processes data and outputs work papers. The social cost is high. You miss birthdays, anniversaries, and gym sessions. Your non-accounting friends stop calling because they know you cannot come out. You are bonded to your audit team by a shared trauma of 90-hour weeks and the smell of stale office air. You're no longer just an observer, and you're a vital cog in the machine of global capital markets. Every number you verify is a brick in the wall of investor confidence. You are tired, but you are part of something bigger than yourself, or at least that is what the firm's recruitment brochure told you. Level 3, the audit senior. You are 25. Your base salary is $110,000. You are the operational engine of the audit. The partners sell the work, the managers review the work, but you actually build the audit from the ground up. You are the ultimate middleman, caught in a permanent squeeze between the total incompetence of the first-year staff below you and the relentless budget-driven demands of the managers above you. Your job is no longer just doing the work, it is fixing the completely ruined work of the associates while simultaneously making it look like the audit is running smoothly and under budget. You manage 3 different client engagements at the same time. You are tracking 50 open requests from the client controller who actively despises you. It is February, the absolute peak of busy season. You're sleeping 4 hours a night. You keep a toothbrush and a change of clothes in your desk drawer. At 2 a.m. on a Thursday, you are reviewing a revenue work paper prepared by a new associate. The client is a software company that just signed a massive multi-year enterprise contract. The associate tied the revenue recognized to the cash received. It looks clean. The numbers match perfectly, but your stomach drops. You remember a passing comment the chief financial officer made during a walkthrough 3 months ago about extended implementation timelines. You open the master service agreement. You read page 62. The contract clearly states that the software deployment requires a highly customized or said an installation phase that has not yet been delivered. Under the accounting standards, they cannot recognize this cash as revenue yet. It is deferred revenue. It is a liability. The client has aggressively front-loaded $25 million in revenue to hit their quarterly earnings target. This is not a rounding error. This is a material misstatement. If the audit report goes out with this number, the financial statements are materially false. You sit in the absolute silence of the empty office. The associate is asleep. The manager is offline. You're holding a ticking time bomb. If you raise this issue, you will blow up the budget, delay the filing deadline, and infuriate the client management team, who will immediately call your partner to complain about your aggressive auditing. But if you ignore it and the regulators find out, your career's over before it even really begins. You spend the next hour documenting your findings. In audit, if it is not documented, it did not happen. You create a deeply detailed memorandum that clearly maps the contract clauses against the 5-step revenue recognition model from the accounting codification. You are building an impenetrable defense for the argument you are about to start. You draft an email to your manager. You attach the contract, the work paper, and the relevant accounting guidance. You state the facts clearly without emotion. You hit send. You close the laptop, but you cannot sleep. You know that tomorrow morning, the entire dynamic of this engagement is going to shift from a routine compliance exercise into a high-stakes corporate confrontation. Level 4, the audit manager. You are 28. Your base salary is $150,000. With your annual bonus, you hit $175,000. You no longer prepare work papers. You review them. Your transition to manager is not a promotion in technical skill. It is a pivot into corporate politics and project economics. You are now responsible for the engagement margin. Every hour your team works is an hour billed against a fixed fee that was negotiated a year ago. If the audit takes longer than expected, the margin drops and your performance rating drops with it. Your phone rings at 7 in the morning. It is the senior from last night. They sent the memo about the $25 million deferred revenue issue. You read the memo. The technical accounting is flawless. The senior is entirely correct. You also know that if you present this to the client, the chief financial officer will threaten to put the audit out for tender next year. You're caught in the permanent tension of the Big Four business model. The public expects you to be an independent watchdog, but the client pays your firm's invoice. You call your partner. The partner listens to the issue, pauses, and tells you to set up a call with the client management team to discuss their perspective. This is a subtle directive for finding a compromise. You sit in a glass conference room with the chief financial officer, the controller, and your audit partner. The chief financial officer is visibly furious. He aggressively explains that the software is technically functional for the end user, even if the highly customized installation phase is not entirely complete. He argues that the commercial spirit of the contract has been met. You know perfectly well that the spirit of the contract does not satisfy the rigid 5-step revenue recognition codification, but you are no longer just a junior auditor looking for absolute black and white truth. You are a corporate negotiator trying to keep a massive account alive without crossing the line into fraud. Over the next 3 days, you basically do not sleep. You draft 6 different technical position papers. You are desperately looking for a loophole, a gray area, or a historical industry precedent that allows the client to recognize at least a portion of the cash right now. You finally find a highly obscure secondary clause in a third-party vendor agreement that allows you to technically unbundle the core software license from the ongoing installation service. It is highly aggressive. It lives at the absolute bleeding edge of acceptable accounting principles. But it technically works. The client gets to recognize $18 million this quarter instead of the full 25. The chief financial officer is not entirely happy, but he pragmatically accepts the adjustment to avoid a delay in the earnings release. The audit partner praises your commercial awareness and your ability to manage a complex client relationship. Your senior looks at you with a quiet mixture of professional betrayal and deep exhaustion. You formally approve the work paper with your digital signature. You tell yourself that this is simply how the complex real world operates, but a very small, quiet part of your brain remembers the rigid ethical principles you learned in your university audit class and wonders exactly when you learned to compromise them. Level 5, the senior manager. You're 32 years old, your base salary is $210,000, and with a strong firm performance, your total compensation pushes past $260,000. You're at the most precarious bottleneck of the entire Big Four pyramid. You are a partner in waiting, which means you are continuously auditioning for a promotion that is statistically highly improbable. Your technical skills are taken for granted. Your only real metric for success is the pipeline. You are no longer judged on the quality of your audit work papers. You are judged on your ability to cross-sell non-audit services to your audit clients. You pitch tax structuring, cybersecurity reviews, and supply chain advisory projects during routine audit update meetings. You have transformed from an independent gatekeeper into a sophisticated corporate salesman. It is late October. One of your largest public clients, a massive media conglomerate, is facing a severe impairment test on their goodwill. 2 years ago, they acquired a digital streaming startup for $400 million. The market environment has drastically changed. The startup is burning cash and missing every single projected user growth metric. Under basic accounting principles, the goodwill on the balance sheet is obviously impaired and needs to be written down. A write-down of this magnitude will completely erase the client's quarterly earnings, crash their stock price, and potentially trigger a default on their strict banking covenants. The chief financial officer casually invites you to a highly exclusive private dinner. Over a $600 bottle of wine, he quietly reminds you that the company's planning to launch a highly lucrative global tax restructuring project next year, and he would love for your firm to win the consulting mandate. The implication hangs in the air, heavy and unspoken. If you force the impairment charge, you lose the audit client, and you definitely lose the consulting fees. You return to the office and schedule an emergency meeting with your internal valuation specialists. You spend 3 grueling days manipulating the discounted cash flow models. You do not falsify the numbers. You simply adjust the subjective assumptions. You lower the weighted average cost of capital by 0.5%. You increase the terminal growth rate by 0.2%. You extend the recovery timeline by 18 months. These are tiny microscopic adjustments hidden deep inside a highly complex financial model, but together, they perfectly bridge the valuation gap. The goodwill passes the impairment test with virtually no room to spare. It is entirely documented, it is mathematically defensible, it exists perfectly within the allowable gray zone of professional judgment. But you know exactly what you did. You engineered a financial fiction to protect a corporate relationship. When the partner signs off on your strategy and praises your ability to navigate complex client sensitivities, you feel a sudden, hollow realization. You are no longer protecting the capital markets or the everyday investors. You are simply protecting the firm's revenue pipeline. Level 6, the audit partner. You are 38 years old. You finally reached the top of the pyramid. You hold equity in the partnership. Your compensation this year is $950,000. You own a house in the suburbs, drive a luxury car, and sit on the boards of local charities. You do not touch the audit software anymore. You do not review work papers or recalculate spreadsheets. Your entire job is managing high-level executive relationships and managing extreme risk. Every single piece of paper generated by your exhausted staff, every compromise made by your stressed managers, every tiny assumption tweaked in a valuation model over the past 15 years culminates in one single action. You place your signature at the bottom of the audit opinion. That signature tells the entire global financial market that the financial statements present fairly in all material respects, the true economic reality of the company. It is a terrifying level of personal accountability. 3 years ago, you signed the audit opinion for a rapidly growing fintech client. You trusted the work of your senior manager, who trusted the work of an overworked senior, who trusted a work paper prepared by a sleep-deprived 22-year-old at 3 in the morning. Today, you receive a formal, certified letter from the Enforcement Division of the Securities and Exchange Commission. The fintech client has just announced a massive restatement of their historical earnings. It turns out the chief executive officer was running an elaborate round-trip revenue scheme with a related party entity in an offshore jurisdiction. The massive revenue numbers your team verified were completely fabricated. The stock price immediately collapses by 80%. The shareholders are filing a massive class action lawsuit, and they are naming your firm as a primary defendant. You are sitting in a sterile, aggressively air-conditioned conference room in Washington, D.C., facing 3 federal investigators. Your firm's general counsel is sitting next to you. The investigators slide a document across the table. It is a printout of an email chain from 3 years ago. It is an email from your former senior auditor flagging a highly unusual series of transactions that lacked proper commercial substance. Below, it is your manager's response, dismissing the concern based on a flimsy management representation letter. The investigator looks at you and asks why you authorized the issuance of an unqualified audit opinion when your own team had clearly identified a massive red flag. Your general counsel begins to recite a carefully prepared legal defense about professional sampling and the inherent limitations of a financial audit. But as you look at the printed email, you realize the brutal truth of the partnership. You made millions of dollars selling trust to the public market, but when the illusion of that trust completely shatters, the market demands a sacrifice, and your name is the only one on the paper. The brutal lesson of the Big Four is that public accounting is rarely about absolute mathematical truth. It is a psychological balancing act between maintaining market confidence and protecting corporate revenue pipelines. Looking ahead, the future of audit will radically change. Artificial intelligence and automated ledgers will inevitably eliminate the endless ticking, tying, and ghosting of hours. However, this advancing technology will never resolve the fundamental human conflict hidden inside the gray zone. The ethical compromises will simply shift from spreadsheets to complex algorithms. So, I must ask, are you truly willing to trade your youth for a partner title and a signature that could ultimately cost you your freedom? What is the darkest ethical compromise you have personally witnessed in your own corporate career? Please drop a comment below and freely share your real experiences with us. We all know the daily reality is much harsher than the glossy recruitment brochures claim. If this deep journey into the financial trenches resonated with you, please take a moment to subscribe, hit the notification bell, and share this video with someone who understands the grind. Your quiet support directly allows me to keep exposing these unspoken corporate truths today.